Mark, let me begin with you. Let's do Netflix because given the run-up since that Christmas Eve, are we coming in too hot in earnings season?
No, I don't think so. I'm more struck by instead of the run up, the run down over the last couple of months. This was, I thought, one of the most dislocated of the large cap internets, this along with Facebook. We had numbers off of the September quarter that actually went up. We think the outlook is very positive for this year. I know there's a lot of overhang related to the competitive OTT launches, Apple, AT&T, Time Warner, Disney. But we think Netflix can power through that and add probably close to the same number of new subs in 19 as they did in 18. If that's true, we think the stock can continue to rally through the year.
Tom, let me pose the same question to you. And given it's the first big FANG to report, to what degree does it set a tone for the quarter?
So generally speaking, I think that 2019, you're going to see the performance of the FANG stocks will diverge. So for Netflix, I do think it's their ability to add customer subs, especially for international, that'll drive their performance in 2019. So I think 2019 could be a good year for Netflix as well.
How about Apple? I mean, I know you make the argument that something new is basically needed here, and that might be M&A. We haven't seen a lot of major M&A from this company in the past. What would they buy now? What should they buy now?
Yeah, I mean, in our opinion, the clock has struck midnight for Apple in terms of content. You know, it's an install-based story here. You have to put more content from a video perspective in there. I believe it's ripe for them to look at an A24, a Sony Pictures, a Lionsgate. Now is the time, in my opinion, if they're not aggressive in M&A from a content perspective, and potentially even going after a Viacom CBS, this will be, in our opinion, the biggest mistake that Cook and Apple has made, because that's the way that the services flywheel is going to work in terms of the install base.
And Mark, along those same lines, what about Amazon? Do they have right now all the pieces that they need to keep this going? I mean, you are very bullish on them. I believe your price target is 2,300, which indicates quite a bit of upside from here. A, do they need anything else? And B, are you concerned about the Jeff McKenzie Bezos situation and what that does for stability?
Okay, well, let's see. Amazon, I think the most consistent fundamentals in large cap internet probably belong to Google and Amazon. And Amazon should have had a really positive fourth quarter. There wasn't any really dislocation in terms of whether all the macro data points looked like they were pretty darn positive in terms of online retail sales, whether we looked at ComScore, Adobe data, MasterCard data, and Amazon should fully participate in that. They also did something that a lot of people didn't realize. They got much more aggressive with free shipping promotions in that fourth quarter. That's probably why they guided margins as conservatively as they did for the quarter. But anyway, we think the near-term numbers for Amazon should be just fine. And the asset has become less and less expensive, is the way I like to say it. So if you can buy Amazon lower than 20 times cash flow or lower than 20 times EBITDA, I think it's a great opportunity to own the stock. And we think this is one of the better points on Amazon right here.
You agree?
So I definitely think Amazon's incredibly well positioned for 2019. Their cloud computing efforts very strong, and we already know that they had a very good holiday. So I think that Amazon's going to have a strong year this year, definitely.
When you say if you think FANG is going to diverge, what diverges to the downside?
I think I think Facebook has the biggest challenge for 2019. They've got a bit of an identity crisis. Apple put out that famous 12-story ad at the Consumer Electronics Show about protecting your privacy. I think finally consumers are starting to care about that, and I think that poses some challenges for Facebook for this year.
And I wonder what you would think of that, because there's some notes that argue the opposite today, at least out of NKM. That the turn in sentiment could happen quickly.
Well, I think it could happen extremely quickly, and that's why I think we're going into a fork in the road earnings season here, specifically for FANG, and I think there's a lot of focus in terms of China, in terms of headwinds for names like Apple, but then you look at ones that are not exposed in terms of tech, like a Microsoft, which continues to be sort of a rock of Gibraltar in terms of large cap tech.
I want to go back to you, Mark, on the Bezos divorce situation. Didn't get your take there. Is that something that investors need to watch in terms of whether it continues to play out amicably? I mean, we got 16% of the company at stake, right?
Yeah, I was actually trying to avoid the question, John. So
yeah, I figured maybe.
I'm not sure.
You're not the first, Mark.
I'm just not sure. That's uncharted territory for me. Looking at the sector as an analyst, so I'm not sure quite how that plays out. I really don't know. Is it a new risk? I guess so. I'm sorry. It's a curveball. I think the investors will still largely focus on the company's fundamentals. 95% of the time they'll focus on the fundamentals. So I'm hoping, and I think that's what's going to happen. That's my best answer to your question.
Tom, I'll put the same question to you, especially given the fact that I would imagine there are investors out there that have invested in this company, not just because of the fundamentals, but because of the visionary sort of track record of Jeff Bezos.
Sure. So here's how I think about it. Jeff Bezos famously said that he runs the company as if he owns 100%. So it's 16% or 1%. I think he'll continue to run the company as if he owned 100%, managing for the long term. That's what's helped the stock do so well up until now. I don't see that changing going forward.
Okay, and given what we saw happen with Wynn, not that we're in that territory now, though, but is that something investors should keep in mind, making sure that this ownership situation remains amicable if Mackenzie Bezos does end up with a significant size stake in the company? Because he might be running it like he's got 100%, but he doesn't.
The other thing I'd point out is if you look at Amazon versus Facebook, there's no super voting shares. So this isn't a case where Bezos has voting control, even with 16%. So again, I think the influence he has is tied to the track record and his vision for the company. I don't think that changes.
Dan, more weak data out of China today, more headlines regarding U.S.-China trade and whether we potentially get a deal there. How do you expect this to play out in terms of your coverage universe in earnings?
Yeah, I think it's the biggest risk for tech, outside of regulatory. And I think right now, in our opinion, specifically a name like Apple, that continues to kind of be a dark cloud on that name. But if you look through the supply chain, we've seen companies like Palo Alto talk about increased expenses from China, and I think that's starting to creep in. We're seeing more and more investors talk about what this could do to the supply chain in terms of increased costs. So in our opinion, this is still a white knuckle situation with China, and I think this is really, in our opinion, the biggest risk to tech stocks, with Apple as a target on its back in particular, front and center.
For almost all of last year, people said it was regulation. That was the big tail risk. You think China replaces that now?
Oh, it's not even a question.
Absolutely, I agree 100%. It's China.
What happened to regulation? Is that gone, or is it just on hold, or is it just subservient to whatever happens in China right now?
Well, I think part of it too is it's reflective. You look at a lot of the stocks like a Facebook, like some of the others, you see reflected in a lot of these valuations. And the biggest thing now in China, it's still that kind of opening the door. You don't know what's behind it in terms of the potential. I think it's the uncertainty in terms of tech. That's the big worry thing that we hear from investors.
Mark, what do you make of that? And which of your names do you think is most exposed to China in a negative way?
Well, I actually think long term, I think it's a negative to not be involved in the Chinese market. Most of these companies that I look at have pretty de minimis presence there, either because of very good local competition, that's Amazon's problem, or because of some government media regulations, sensitivities. That's Google's problem, and that's Facebook's problem. So it's a pretty small market for all of them, although there are Chinese advertisers that are clearly using Google and Facebook to market their products and their services outside of that country. The regulation is a bigger issue for these companies, but I do think that we probably, I don't know if it's peak reg, but we had a lot of regulatory pressure on this whole group last year. GDPR, $5 billion fine that Google had to pay, and then a slew of congressional hearings and testimonies. My guess is that this environment this year is not going to be as heated as it was last year. And so you could see a little bit of a re-rating in the shares just because the regulatory overhang will never be removed, but it will lessen this year.